It's a real pleasure to introduce Attorney Jonathan Gudema. Jonathan, please correct is it Gudema?
Yeah, Gudema.
Gudema, thank you. Who is currently working with the Ecumenical Patriarch Bartholomew Foundation to help us launch our planned Giving Legacy program. Giving, that is to say, giving through estates and trusts, as well as tax advantage structures like charitable trusts that can provide income to us and create a legacy gift along with other immediate tax benefits. In addition to helping supporters of nonprofits with structured gift plans, as Jonathan has done, Jonathan is an attorney for a family wealth office and has been carefully tracking a series of potential tax law changes that could have a significant effect on our retirement and estate plans. While these potential changes are constantly in flux and may or may not happen, just tune in today's news, Jonathan felt that the changes being proposed were so substantial that it was important for our supporters to hear more details and potentially start planning for dramatic changes in the area of gift, estate, income, and capital gains taxes. Jonathan has been an attorney since 1994. He was in a general practice law firm until 1998, and then moved into estate and trusts and working with nonprofits. In 2011, he launched his firm, and this is who we engaged, Planned Giving Advisors, where he helps nonprofits with their legacy giving program and also serves as counsel to a family wealth office since 2006. It's an honor and pleasure to introduce Attorney Jonathan Gudema. Thank you.
Thank you so much, Anthony. Okay, so I'm going to try to go methodically through the topic today. There is a lot there. And as Dr. Literack has just mentioned, it's in flux so much. Normally, I wait until things get closer to passage before I start talking about them. But these proposals have been very serious, and depending on the circumstances, they could all be passed. It's not so far-fetched. It happens that the last week things have changed a little bit, so I'm not going to get into the politics, but it looks like things might not be so easy for the president to pass things quickly through. So, up until 2 or 3 weeks ago, it may have been moving towards, they could have been passing the infrastructure, President Biden's infrastructure plans, which includes the income tax and some of the capital gains increases. But now things have slowed down. So a lot of this we will not know until it gets closer, but it's still worthwhile to see what is out there. So that's my goal today, to cover these things, to give you some basic information, and I'll try to go methodically through it, but go quickly. So feel free to ask questions. I'd actually rather you wait to the end to ask the questions. And also you can always reach me through the foundation if you have questions afterwards, and that might be better because there's a lot of people on this call. Okay, so we're going to talk about the current state of taxes, just a quick review, income tax, capital gains, gifts and estates, and then the current bills. Well, there's a 99.5% Act, something called the Sensible Taxation Equity Promotion Act, STEP, and President Biden's tax increase plans. That's really part of the infrastructure plan. And then we're trying to suggest what's realistically at stake and what are some realistic options to consider. And I want to swing back to also the basics of estate planning, because as you hear me speaking, and you may not be familiar with some of the numbers involved, it might not even apply to you because these figures are pretty large amounts. So you may be just not applied to you at all, and we just want to have a little bit of talking about basic estate planning, particularly in light of the work I'm doing for the foundation in terms of encouraging individuals to think about including them in their estate plans and other structured gifts. Okay, the current state of taxes. Okay, so the tax brackets, it ranges from 10 to 37%. We have a standard deduction, which every individual, if you don't have enough itemized deductions, you can take, each individual gets 12,400. This was set in 2018. And the state and SALT, the state and local tax, that's been capped. I think that's actually something that might change. I think there's some pressure to undo that, but that basically limits your deduction for your state and local taxes, which those of us live in New York, New Jersey, California, higher tax states, it's a bit of a hit for us, but that's the current state of taxes, income taxes. Capital gains, there are basically four brackets. Officially, there are three brackets, 0%, 15, and 20. But you'll see, as we'll get to in a couple of slides, why do I have 18.8 and 23.8? I'll describe that in a couple of minutes. But that's basically four levels. And the federal state gift tax, federal state and gift tax, it's called a unified tax. Whether you make gifts during your life to individuals or you live in your state or a combination, that doesn't touch an individual. For federal estate taxes, doesn't start until 11.7 million per person, and the top rate is 40%. Again, that's definitely at stake, so we're going to talk about that. Then there's currently we have what's called the annual gift exclusion. You can make, I'm sure most of you are familiar with this, you can make as many $15,000 gifts. This is to individuals, of course. I'm not talking to charity, as you want. So you can, as no limit on the number of recipients. And there's no limit on how much each recipient can receive from different people. There's something called a step up in basis. It sounds like a very technical term, but it's very important. This has basically been the law at least since the 1960s. Only 2 years it wasn't the law. This is where if somebody passes away, the capital gains that the person may have owed during their life are wiped out, so that the people who inherit the asset inherit with what's called a stepped up basis for tax for determining the future capital gains. And now I heard a lawyer said, well, that's a freebie. But the truth is your state could be paying estate taxes. So this is sort of a trade-off. It was too difficult to understand to figure out the capital gains going back generations sometimes. So this has been the law for a long time. This is something they're looking at. And that's why I'm mentioning it. There's something called the stretch IRA. If you've done any complex planning with your individual retirement accounts, this was a way to stretch out, reduce the taxation and take advantage of multi-generations of pushing out the recipients of your IRAs, inheritors of your IRAs, from having to pay a lot of taxes or pushing out for many generations. But those are gone. I just wanted to mention that if you had any complex IRA plans, those were taken out in January 1st, 2020. Just something to mention. That only applies if the lawyers sat with you and created complex plans, but we'll just mention that. And then right now, required minimum distributions from your IRAs and other retirement accounts starts at age 72. Hold on a second. No, and there was now there's actually no age limit. So you could actually, if you're still working in your 70s, only if you're working, you can make new additions to your IRAs. This was a relatively new law also. This is January 1st, 2020. And this is the most recent tax brackets. I like to show people the brackets, and I actually want to explain something to everybody very quickly. So one of the misconceptions about taxes is that, oh no, what if I have income and I go right over somehow, let's say somebody's earning in between 22% bracket and 24%, let's say a single individual. What if their income goes above 85,000? Now this is, by the way, is taxable income. This is after all your deductions, and then they apply the tax rate. But the way that tax rate works is, let's say you're a single individual and you earned $100,000. You would not be paying 24% on that $100,000. I mean, that's your taxable income after your deductions, but you still wouldn't pay 24%. Your first $9,875 pays 10%, and then the next level pays 12%. So it's graduated, so that the actual rate for someone, let's say, earning a single individual with a taxable income of 100,000, it's probably around 16-17% would be owed in federal taxes. But of course, if you have a job, you're most likely withholding. If you have a business, you're supposed to send quarterly payments to pay those taxes. So chances are you may not owe anything because maybe the government owes you money. And so this is, again, just to take a look at the brackets and how they break out. I'll show you a couple different versions of this so we can move on. But this is 2020, and I'll show you the 2021 in a second. And federal, just a quick review on federal tax on appreciated assets. Basically, capital gains taxes. It applies to capital assets, mainly stocks, maybe real estate, could even be bonds, or could be car if a car would have value, but that usually is not the case. And then the capital gain is any increase in value on a capital asset when the asset is sold. Again, I'm mentioning these things because this has been standard for many years, and these things may change. That's when you might have to pay a capital gain. Your difference from your purchase price to the sale price, and there could be adjustments to your what's called your basis. Your purchase price is called the adjusted basis. For example, your house. I like to use an example. My mom recently sold her house. She bought her house, and my parents bought the house in 1968 for $30,000. She just sold it for $500,000, and she gets a free $250,000 capital gains. So that's every individual for their personal residence is entitled to that. If you living there for a couple of years or more. So you would say, okay, her purchase price was 30 and she gets an extra 250. So the gain would be between 280 and 500. But actually, we told the accountant, said, well, she also did replace the roof and she did other capital improvements. So in the end, she paid no capital gains. So that's exactly how capital gains will work. Again, the tax on the profit, but again, there may be some adjustments there. Again, I keep mentioning the word cost basis. That's basically your original purchase price, but again, it gets adjusted for, in stocks, it could be stock splits, dividends, return of capital distributions, things like that. And of course, if you sell an appreciated asset within 12 months, it does not get the lower capital gains rate. It gets taxed as ordinary income. And generally, of course, capital gains rates have been lower, significantly lower than ordinary income tax rates. And for people who invest, it's important to know that because it's encouraging people to invest in companies and things that will grow over time, knowing that there won't be such a large tax when they eventually sell it. I mentioned already, the step up in basis is that capital gains are eliminated at death for the heirs. So the heirs, if there's no federal estate tax, there's also no capital gains tax also. Okay, so here's our chart. I'm going to show you how this changes. Again, this is the 2021 for this year, the income and capital gains. So what I did here was I showed you income up to a certain amount pays this rate, and then the capital gains is a little on the side here. So capital gains, if you earn less than $40,000, your capital gains rate is 0%. But once you're over that, it's 15%. And then once you exceed 200,000, that's actually your AGI, your adjusted gross income, not your taxable income. But once your AGI exceeds 200, your capital gains rate jumps up to 18.8 because then you get the Obamacare tax at 3.8% applies. And then once you exceed this next level here, I hope you see my cursor, $445,000 range. That's when your income goes over that. Then you get this highest capital gains rate, which is 20% plus the Obamacare 3.8. So that's where you get the 3.8. So just you have this. And by the way, if you want a copy of the presentation, I'm sure Ever will send it out to everybody afterwards in the follow-up. So this is a chart just to give us a visual on how the taxes are playing out. And just a little bit on the federal gift and estate taxes. Again, estate tax is a tax on the estate whose value exceeds a certain exclusion. That's important, that term exclusion. I already mentioned the exclusion. It's actually 11.7 million per person. Gift tax is aligned with the estate taxes. So you can make gifts up to 11.7 million during your life and owe no gift tax or estate tax. That's kind of unusual, but it does happen. And so what the government does is, as you make gifts above that $15,000 level, which I mentioned already, then it has to be reported on in your tax return, what's called a gift tax return, and they keep track of it. So each year when there's a new gift, the accountant has to go back and take a look at what your total giving has been so far. So that's how they keep track of your lifetime giving. So it's uniform. It's called the uniform transfer tax. It's a policy to try to keep these things uniform so that there's no advantage over one or the other in terms of planning. So people can use it while they're alive, or they could use it in their estate. It's called uniform gift and estate tax. And then there's this lifetime exemption, which I mentioned. Again, I'll show you in the next slide. I'll show you what the amount is. And again, I already mentioned the annual gift tax exclusion. That's the free gifts that you can make without having to report anything to the government. And you can make it into as many people as you want, up to 15,000 per person. And a husband and wife each get the 15,000. So they could be giving children 30,000 a year. That's actually a very basic estate planning option that if you want to start moving assets to your children, you can do that. But I actually sometimes tell people, they come to me and they're nervous. Well, what should we do? It's a couple $100,000, and should we try to stick within the 15,000 a year or 30,000 a year? I said, no, just if you want to make the gift to the next generation, you could give to them now, and just to let your accountant know, and they'll tell the government you made a $300,000 gift. You're very far away from estate tax, so there's nothing to be paid. But the annual gift tax exclusion is important to know it's there, and we'll see, because they're thinking about changing it. That's why I want to mention it. Okay, so let's take a look at the gift and estate tax. I would say the gift and estate tax applies to very few people. I've already mentioned it. There's numbers. Let's just look at the 2021 numbers. 23.4 million per couple. So that's one of the reasons why I include at the end of this presentation. Let's get back to some realistic basic estate planning, because this may not apply to you. And now, if it does apply to you, you're going to want to pay very close attention to some of the things I say. So that's where it's it's very significant. But again, that's on the table right now. And this also basically includes what's called GST, generation skipping tax. I'm not going to go into that too much. It's basically you're able to utilize this exemption for gifts to grandchildren also. But basically what attorneys do is they create trusts that utilize this exemption, so it can be for your children and for your grandchildren. And that's a pretty common stuff if there's planning and there's grandchildren involved. So a lot of flexibility right now. Again, the annual gift tax exclusion changes every now and then. It used to be 10,000 and slowly went up to 15. Again, no limit on the person. Take a look at this chart here, and this is now to give us a little starting to get into where we're going, where we might go. Again, things changed recently, so I feel that some of this now is less likely to occur, but I think you have to still pay attention. So this is a chart talking about the estate tax exemption level, the lifetime gift tax exemption back in 1997. When I started paying attention to this, and I was moving more into work with nonprofits, it was 600,000, whether you're a gift in your estate or during life, and the maximum estate tax rate was 55%. So that was pretty onerous, and there was pushback, and President Bush made an effort to get rid of the estate tax, but he couldn't really get rid of it. Basically, particularly if you don't have help from the other side of the other party, you can basically have a 10-year limit. So a lot of these laws, you create these tax, you can even reduce government revenue, but you've got a 10-year window. And so if you ever noticed, these big tax law changes usually expire in 10 years. So the President Bush tax cuts, particularly on estate taxes, so he increased they expired in 2010 basically. And then we had a couple years of negotiations, left us basically 2011 to 2017 was basically 5 million per person. A little adjustments for inflation, and the maximum estate tax rate was in that 35 to 40% area. And then last couple of years, since the Trump tax changes in 2018, jumped it up very high. But there is the 99.5% Act, and that is Bernie Sanders, Senator Sanders from Vermont, has posed this more than once. This is something, an issue for him, and it's back on the table. So what he's proposing is reducing the exemption down, bringing it back down to 3.5 million per person on the estate side, but actually capping people's ability to make a gift during life at $1 million before they have to start paying taxes. So that's basically throwing us back to 2009 levels. And actually, also we'll talk about it a little bit. He's proposing the rate to be 45% for most states, but then once you get much higher, it starts jumping, and the billionaires could even be facing a 65% estate tax. That's very significant. And on top of that, there's something called the STEP. I mentioned already, STEP Act. That's from a different senator, has proposed to basically make major changes to the step up in basis at death, which could create very complicated things. And I'll try to give you a little overview of that as we go through it. So let's talk about the bills. Again, so we mentioned already the 99.5% Act, the STEP Act, and then President Biden is basically part of his infrastructure plans, his tax increases, and I'll talk about those in a second. Those were more likely to happen, but they were trying to start working on that already. Back to for the 99.5% Act, again, it's going to drop our state tax exemption per person to 3.5 million. A question I got, I've given this presentation several times already. Question, what if you've already used 11.7 or whatever, more than that? Well, it's as long as you've done it already, you're good. And they said, what if we're going to do it before the end of the year? You actually find the law is not retroactive. So you have law kick in January 1st if it's passed this year, which is at this point, I thought it was likely. Now I'm thinking it's not so likely right now, but you'd have time to do some planning if you hadn't done your planning already. It's going to have some different estate tax brackets, basically 45% for the lower level up to 10 million, and then going into 55 and then to 65%. But 65 is only for very large estates over $1 billion. But it's still pretty excessive tax there. And they're proposing, and I'm kind of surprised at this. They're basically taking away. He wants to change the annual gift tax exclusion, that free $15,000 per person. He wants to cap it and really limit it quite a bit. He wants to limit $10,000 per donee, meaning any recipient can only get $10,000, and the donors themselves, individuals, can only give out $20,000, which basically takes away it eliminates the annual gift tax option for estate planning, which is a basic estate planning piece of advice. It basically, just you'd be maxed out at $20,000 if you want, and you could only give up to $10,000 per individual. So that's a pretty big change. On top of that, now I'm going to mention a couple things here that I'm not going to go into detail, but I will tell you they're going to do something to dynasty trusts and other sophisticated plans. I just want to say that basically my role is in the Family Wealth Office. I've drafted some of the trusts, but basically we use outside law firms to do the highest level planning, because it's about $1 billion estate plan that we're working on. So there's always work to do. I could tell you that somebody in some lawyers, one or more lawyers who do all the highest end tax planning, basically told the Sanders people what to go after. So I can tell you that estate planning attorneys are very, very concerned about the various trusts and various plans that they've been implementing with their clients. A lot of them, I don't know, we're not sure yet. The lawyers I work with, the law firms that we work with for this family have not told us to do anything yet, but I'm sure the moment it becomes getting closer and closer, before the end of the year, we're going to be doing a lot of adjustments, because they're aiming at exactly what the estate planning attorneys are doing with their clients. A little mention of the STEP Act. This is going after the step up in basis. It's kind of interesting how they little play in the words. They call it, the term is STEP, and it's going after the step up in basis. What does this mean? Basically, they're trying to cap the capital gains exclusion. This is if somebody passes away, only the first $1 million of capital gains that's being avoided would be free of capital gains for the heirs, and then beyond that, they would start taxing capital gains at presumably the rate, the brackets I told you, different levels, 15, 20%. I don't think the Obamacare tax would apply there. So looking at a potential capital gains above $1 million after someone passes away in the estate. So the estate, when there's an estate, the estate has its own tax return, because it may have some income taxes that have come in, and then you'd have to potentially pay capital gains taxes and any potential state taxes. So this is very significant. But this is I think this is even more significant. What they're trying to do is go after any transfers during life to a trust, I can just tell you that this family that I've done work for, we've transferred hundreds of millions of dollars to trusts. I mean, maybe as high as $500 million to trusts. They're looking now to any transfer to a trust or to an individual other than a spouse, they're only going to get $300,000 of cumulative gain to be tax-free, and they're going to start taxing it. So it's going to be this is a very complex proposal, because basically what it would mean is that you would have to pay capital gains on transfers, but the assets aren't being sold. So somebody would have to really keep track of how much capital gains you've already paid on anything above $100,000. I think this is, to me, just from a practical point of view, this gets me very nervous. And you just note that in 1976 and 2010, there was actually 2 years where the step up in basis was basically revoked, wasn't there. And both times it was such a mess that Congress had to retroactively undo it. So, this type of law, if this goes through, would likely have to be undone because it would create such confusion. And even this, and then the question you have to ask is, wait a second, what if a family is going to inherit a illiquid property, a farm, things like that? That's a classic example. It could be something else. And how are they going to pay taxes on that? They're going to have to sell it at a law and to pay the capital gains. So they said, no, what we'll do is we'll put a lien on your property for the capital gains your state is supposed to pay. And over the first 5 years, you can pay interest. Your state will pay the interest on what you would have to pay, and then you can pay the rest out over 10 more years. But again, this doesn't sound so. It sounds a little complicated, but this is what's being proposed. Now, interestingly enough, this act, the previous one I mentioned would start January 1st, 2022. This one would apply retroactively. So this is, I think that itself also, there'll be no way to react to it. It's already too late. So again, this is a little bit of a aggressive one. So what's really being proposed? I think I covered it. Basically, any estate would owe capital gains in excess of any estate transferring with gains over $1 million. They're going to have to start paying the 15 or 20% bracket. But then Biden, and part of his, we're going to talk about in a second. Part of he's looking to knock up the capital gains rate for anybody making $1 million or more to 39.6% from that 23.8%. So maybe that would apply to, it's hard to say that. I don't know the answer to that. Illiquid assets would have basically 15 years to pay the gains. And during life, you could only, once you exceed a $100,000 transfer to a trust, some sort of estate planning thing, you'd have to start paying capital gains up front, even though the property is not sold, which again, that creates some confusion. Basically, there is a movement to take away the free step up in basis at death. I'm not exactly sure why, because that just creates a lot of confusion, but that's out there. I was surprised that this is the case. In my entire career in tax and estate planning, we always laughed about the 1976, where it was such a mess that they had to retroactively undo the law. Yet now we're back to trying to do it again. And the more, I guess, the biggest one is the President Biden's. He wants to pay for the infrastructure plan with tax increases. Firstly, he wants to knock up the highest rate to from 37% to 39.6%. And then he wants to tax long-term capital gains and qualified dividends. Again, I want you to remember, I didn't mention it, but capital gains and dividends get that same capital gains rate. That's been the law since George Bush's, the Bush tax cuts in 2001. So, and that's been very successful over this time period. But he wants, if you earn over $1 million, he wants to knock up that capital gains and qualified dividends to knock it up to 39.6%. So basically, what you're talking about is, again, every time you have this type of tax, you have to add on the Obamacare tax. That would basically knock up the federal capital gains rate for those individuals to 43.4% on capital gains and dividends, almost basically doubling the current rate. And again, if you throw in state taxes, if you live in a state that has the state taxes, that could mean over a 50% tax on gains. So I think that's just something to keep in mind, but only for people on the earning $1 million or more. Again, this is something that they want to implement. They want to cap. I'm not going to go into the details on this bullet point. Just they're looking to cap the value of your itemized deductions to 28%. So if you're a 37% bracket, for example, then basically if you have a deductible dollar, it's worth 37 cents on the dollar as a deduction. But they want to cap it at 28 cents on the dollar. So you can do the math in your head. Wow, that's actually a pretty significant. It's basically a backdoor tax. That's something that they're thinking about doing, and some other ways to raise revenue without people realizing they actually raise the taxes. On this bullet point, it's actually very complicated. It would take a lot of time here. I don't want to get into that, and it's, but it's that type of stuff likely to happen. If there's even if there's a compromise, this stuff might happen. So here's what the new chart looks like based on the Biden tax proposal. Just the whole point is just that down here, all of a sudden you have this new level capital gains rate, which is basically 43.4%. And I didn't even mention it, that they're not even sure. Well, what's not sure. It's I saw somewhere saying that in the top bracket joint, if you're in a top bracket now, you go up to 39.6% for income above, again, 523,600. So again, it only applies to that level income, but they're actually starting the highest bracket lower, around the $400,000 mark. And so the president did promise no new taxes, no tax increases for those earning 400 or less. So there's still talk of putting it down lower. But again, we just saw this past week a defection on the Democratic side. So the rush to get this all put through has slowed down quite a bit. So we'll see if this actually happens, but it could be very significant tax increases. Just a quick mention of COVID relief. Individuals, by the way, if you're not an itemizer, whoever does your taxes for you, or do your taxes yourself, if you're that $12,000 exemption, so you could take the standard deduction, $12,400 per person. If your deductions don't exceed $12,400, but what that meant is you don't get an income tax benefit for charitable gifts. So they did include this, and this is now at least through this year. If you're married, you're filing jointly, you can take a $600 deduction for charitable gifts, even if you're a non-itemizer, and $300 per other filers. So that's from COVID relief. And also COVID relief, interesting, this might apply if you're making big gifts to the foundation. There's a ceiling on how much you can deduct in any 1 year. The current ceiling is 60% of your AGI, of your adjusted gross income, you can deduct. If you're giving cash, and if you want to put in appreciated property, you can deduct up to 30% of your AGI. But in 2021, it was the same thing for last year. You can deduct up to 100% of your adjusted gross income if for cash gifts only. So that's just something that's there. I doubt that it'll continue beyond the year, but I actually have spoken with individuals where actually this was something they were doing because they're making large gifts this year and they wanted to deduct as much as possible. Okay, so just quick, I do want to talk about what's realistically at stake. Again, this is in flux. It does change. When I started doing this presentation, it looked like a lot of this would happen, and people would say to me, "It can't happen." So all you need is 51 votes, and they can put it through that reconciliation process, and it could happen. But losing one vote changes it quite a bit. So there could be some compromise coming, and we'll see what the end result will be. I do think that a lot of the state tax exemption and clearly the gift tax exemption, which are at stake. They're going after higher capital gains and higher dividend rates for higher earners. Again, if there's a compromise, it will definitely be an increase. The question will be as high as they're proposing. Definitely higher income for higher level earners. Again, this is something that people might start planning for. That really depends on how you want to structure your income. They're going after, the free step up at death, free capital gains that step up at death. That's I think that's definitely at stake. I don't think there's enough people out there to protest against that. So I think that may get changed, but I think it'll probably, if it gets changed, it'll probably create such problems that they may have to retroactively undo it like they've done in the past. And then this taxation of capital gains on non-sale gift transfers of over 100,000 games to a trust or to an individual. That's possibly at stake. I mean, that's what they're proposing. And then clearly, if you've done any sophisticated estate planning, you have to be in touch with your estate planning attorneys as this thing gets close. These get closer to passage. Again, there's no guarantee that any of them will pass, but I think a lot of it will get passed. All right, so just a couple things out there just for people to think about. Just number one, if you have assets in these levels, around the 3.5 million mark and higher, but yet haven't utilized your lifetime gift exemption, you might want to utilize this. Again, you want to do this, of course, in working with your attorneys, various different ways you can do it. And again, you have up to 11.7 million per person, at least through the end of this year, to transfer without any federal, state, or gift tax. And another issue people should think, they might start thinking about rebalancing their portfolios. Again, I'm not going to get involved in advice on investments, but maybe there's ways for people to change, get out of some of the low basis dividend stocks. One of the fears of taxing dividends higher is that will then be less incentive to own those stocks, and that could affect the stock market. But again, I'm not an expert in investments, so I'm not going to comment much on that. And maybe people will be looking for longer term growth horizon investments. Again, the good news with all tax changes is that there's always a time frame. It never lasts forever, because there's always within 4 to 6 years, there's always could be multiple governments, it could be a new president, it could be new Congresses. So they changed relatively often, actually. People might want to convert IRAs, 401ks into Roths, which is basically means when you do that type of conversion, you have to pay income tax on wherever you're converting. The Roth preserves the growth as tax-free. So that's been going on for many years already. Again, that's something that's out there for people to consider. Some of the charitable ideas that we mentioned at the beginning, there's a structure, it's called planned giving structure, called a charitable remainder trust, or another one called a charitable gift annuity. They're basically the same. These things allow you to cash in highly appreciated stocks with no tax loss. These things might become very important, particularly as the rates change, if they are changed. And you get great income. You get an income for yourself and or a loved one or a spouse. And you might even have some tax-free income. But again, that's for another day in terms of what that involves. And you get an income tax deduction up front. Again, not for the full amount, because you're keeping the income. That's a classic planned gift. There's a very sophisticated gift called a charitable lead trust. It's a way for your significant wealth transfers to heirs and reduce the gift tax valuation. These might become very popular estate planning options if some of these laws get passed, particularly the 99.5% Act, which is going after one of the standard ways of estate planning that does involve charity, will be gone. So now they'll maybe turn back to these types of trusts. And these trusts create a fixed income stream to charity, and they could actually get an income tax deduction for upfront, and maybe some delay of capital gains. But again, these are very sophisticated option. If anything here, if you're interested at all in any of these things, or you just want more information, you can reach out. You have my email, the foundation email, or you can reach out to the foundation, and I can provide more information on these individual things. Charitable IRA rollover. These are direct IRA giving. You can give up to 100,000 from your IRA if you're age 70 and a half or older. It's very important. You have to have reached your 70.5 birthday. So, but if you're doing any giving and you've reached that age, and you have money in your IRA, that's something you should definitely keep in mind. And that gives you an actual tax benefit, even if you're no longer an itemizer. So even if you're not, you could give people give $1,000, they can give it out of the IRA. It's equivalent of $1,000 income tax deduction. So if you're not an itemizer, giving from your IRA once you hit that age, very important to know. And actually, if you're once you're age 72 and you have these required minimum distributions, RMDs, the distributions to charity are actually cover your RMD. So let's say your RMD is $10,000 for this year, and you're at that age, you can actually make $10,000 gift to the foundation, and that would satisfy your required minimum distribution, and therefore you pay no income tax on your RMD. And I think a donation of appreciated stock and real estate, these are also ideas. Particularly if these laws get implemented, you're going to think twice about selling things, because you might, if the higher capital gains rates applies to you. So if you're doing charitable giving, you may want to think about real estate or appreciated stock, because you avoid the capital gains when you transfer directly these either stock or real estate to a charity. You avoid any capital gains on that gift, and you get a full fair market value income tax deduction, and you make a big impact today, of course. Okay, so I want to spend just 5 minutes or so on because some of the things we mentioned today may not apply to some of you or many of you. Just a quick review on estate planning basics. These things really never change. Basically, the main advice I try to give people is to try to work on this sooner than later. You don't want to wait until there's an emergency situation. So you don't want to push this off. The main thing is organizing your finances, so that you know what you have. Okay, so the main thing is that you want to organize. I left off talking about your finances, but you also want to organize your emergency caretakers. Make sure you have 1 or 2 younger people available, family members or friends, to step in case of emergency or disability, or your planning documents. I just did a will with a client, and we're going to have I told her either a safe place which her son knows where to find them, or have her son, if he feels capable, to hold on to the documents. But you have to think about how will these documents be found in case of emergency, and follow through. In the basic estate planning is you should have a will, do a power of attorney. You pick somebody who can take over in case you're not able to handle your finances. A living will, healthcare proxy, again, that's for medical issues. Appointing individuals to help make those decisions, and maybe there's some religious considerations involved there. And beneficiary designation. That sounds like a small thing there, but actually it's probably one of the most important things. What I mean by beneficiary designations, that is your IRAs, your 401ks, your retirement plans, your bank accounts. You can designate beneficiaries of those, and those are actually not even covered by your will. So you got to be careful. You got to coordinate between your will, what you want to do in your basic estate plan, and those beneficiary designations, because it's not covered by your will. And a couple, you should have a will, basically. I mean, you want to decide how to distribute your estate. If you have minor children, of course, you have to take care of them. You can cut down on the probate process. You can minimize estate and other after that death taxes. Again, if it applies to you. And you decide who will wind up your affairs. You could disinherit individuals who would otherwise stand to inherit, make gifts to the foundation, other nonprofits. It's a very important potential gift option through your wills, if you haven't thought about that. And of course, it avoids legal challenges. And it's also because you can change your mind. If things change, you can definitely just change your mind. That's and again, that's all part of your will. You just a estate planning checklist. Think about your goals. Getting organized, very important. Thinking about knowing your full financial situation, where everything's at. Crucial documents created, and updating those beneficiary designations, entitled assets properly, appropriately, because you want to make sure that, again, whoever you want to designate your assets to go to, they work. So again, your will only covers things that are not designated, but if you designate property, it'll go straight to those people or institutions that you designate. And you want to communicate this with those who are involved. Very important that they're ready for this in case it comes up sooner than later. You never know. So you want to have things in place, and you want to regularly look it over. Particularly if major life events happen, maybe time to rethink it. Okay, so last and this is really important. I always advise people to avoid rash reactions to any of this stuff. Even though I started doing these presentations, I do think a lot of what I've mentioned, it seems extreme, but I do think a lot of it will be passed. I think even though the Democrats have lost the ability at this point to get to push things through with reconciliation, which is basically 51 votes. There's some compromise may start happening, and but a lot of this may come to happen, and pretty likely actually. But you want to avoid being rash. You want to meet with your advisors. You want to think about your next moves. Of course, and your advisor, in particular your estate planning attorney, if you have one, particularly if you have unused lifetime exemption, or you have some sophisticated trusts in place. Again, it's an absolute necessity to be reaching out to them as these laws are adjusted. Of course, you can review your investments with your financial advisors. Again, maybe I've already talked to some advisors, professional advisors, and they've told me they're also monitoring what's happening so they can provide options for their clients. Okay, so I apologize for the unexpected crashing, but I think we actually still got in on time. We were scheduled for an hour. I'm here if you want to ask any questions. There is also my email address at the foundation. So you can reach out to me directly, or you can reach out to the foundation and they can reach out to me in terms of any questions or any further information. Again, so I do work with the foundation to help with their Plain Giving program. And I can also answer any of these questions you may have about these laws. I can't be your attorney because I'm working for the foundation, but I can give some off the record advice and some guidance. But ultimately, of course, you'd have to go to your own estate planning attorneys to implement things. But if you're doing something for the foundation, I can be involved in that type of plans.